Right. Thank you for joining today. My name is Manoj Abhichandani, and I'm going to present today about how the ATO's view has changed over the last year and what the issues are for us going forward. Now, I'm going to discuss the meaning of exempt current pension income. There will be some people in the audience, some of you who may have very basic knowledge. So I'm going to lift them up and make them understand what is exempt current pension income. So some of you will find the initial slides a little bit boring, but then we'll catch up, and then this presentation is very graphical. So there's more of understanding than text material which I've put here, and the concepts of exempt current pension income is explained. So my ultimate aim is that you understand the logic behind the ATO's view instead of what the legislation talks about. Now, we're going to talk about what the industry does, what it has been doing over the years, and what is the ATO's new view, and what are the problems in following the ATO's view, and strategies on how we can manage the ATO's new view so that we don't make the calculation very complex, because as it is, it's quite complex on how a fund can claim an exempt current pension income. Now, just some housekeeping rules for audio purposes. If you cannot hear me, believe me, I'm on a very good connection. There is a phone number in your panel. If you ring that number, you will have to enter the access code, and you will then be able to hear me through your phone instead of your headset. As far as the handout is concerned, I've uploaded my handout today. So if you can double click on your panel, you will be able to download. If you cannot, for some reason, um, download this presentation, you're more than welcome to send us an email, and we will forward you this presentation. Now, I know that this is a very complex issue. You may have some questions. So what I'll do is you can keep on typing your questions if you think of any in your panel. And at the end of the presentation, if some of you want to stay back, and listen to what other people have asked, you're more than welcome to. And I'll read out every question for all of you, and then I'll try and answer to the best of my ability. Okay, so this is just a brief on myself, but I can see with the attendees, most of you know me. I've been around for a while, and uh, most of you are probably connecting me via the SMSF audit software. So, and I'm going to talk a little bit about that on how we intend to improve the actuarial certificate, the application process for the actuarial certificate. Now, income is, let's start with the whole issue of income. Income is taxed. A self-managed super fund would have ordinary income, and it is taxed. A statutory income is taxed. Now, what we're talking about here is income earned by the fund. Income could be in the form of interest, it could be form of dividend, it could be in the form of rental income, and these incomes can be exempt provided those assets are actually supporting a pension. And we're going to talk about the legislation part. But some of the income can never be exempt, and we're talking about contributions, tax on contributions. We're talking about tax on non-arm's length income, where a fund has received some discretionary trust distributions, or it has lent money, or it has borrowed money from a related party, and the income which is being derived from is at non-arm's length. So, whatever exemption we claim from the income of the fund, it should be supporting a pension. Now, if some of the assets are not supporting a pension, then obviously income is not exempt. Now, when we start the pension, we start with the purchase price of the pension, and each financial year on 30th of June, we revalue all the assets of the fund, and if the value of the assets has gone down, we credit the value of the asset has gone down, we debit the balance of the member, we reduce the balance of the member, but if the assets have gone up, we increase the value of the members. So when a year starts, when an income year starts on 30th of June, we have valued these assets. And when the income year starts on 1st of July, we have a certain value of a pension account. And if the fund has got an accumulation account, then we have the value of the member who are on accumulation. So when the year starts, the income year when it starts, we have to look at the proportion because the income is earned during the year for the whole year, and we have to look at how much money we have in the pension account and how much money we have in the accumulation account, because the legislation section 295, and I'm going to come to that very soon, talks about a percentage of income, because there are some assets which are mixed, they are not segregated, they are not marked specifically for pension members. So there could be a situation where we have one rental property of say $3 million, and the pensioner has a balance of 2 million, and that one property is like a mixed asset. You cannot differentiate between accumulation and pension members. So what we do is whatever the rent is coming in, we proportionate the balances of the two types of members, pension members and accumulation members, and then we obtain an actuarial certificate. So this is not an automatic claim. Without an actuarial certificate, you actually cannot claim this deduction from income. As long as the minimum pension is paid, this claim is valid. So if you do not meet any pension standards, then that means the pension has ceased on 1st of July. The pension never existed. And if the pension never existed, the balance of all the members was in accumulation, and hence no deduction is allowed. Now, this issue of balance transfer cap has made the issue quite complicated, because if you have clients who have more than $1.6 million on 1st of July going into pension, you will see that some of the balance on 1st of July has to be moved on or to accumulation account. But what we had to do was, because on 1st of July, now this is really silly, first thing in the morning, midnight of 30th of June, the balance has actually moved across into the new income year. So what we had to do was we had to, on 30th of June, now 30th of June is 24 hours. So on the midnight of the 29th, we had to move all the assets of the fund, which were over and above the 1.6 million, into an accumulation phase. And then we have to work out if on 30th of June, if we have earned any income, whether a part of that income will pay tax or not. So I'm going to discuss that as well. Now, going forward, first thing I must explain to you, and some of you who are new to this terminology, and they get confused with the word current. What does current mean? Current assets are those assets which are earmarked or which are actually paying a pension. Now, a fund can have non-current assets. Non-current assets are actually non-current pension assets, and these non-current pension assets are actually those assets which are representing accumulation account of some of the members. Now, one has to remember when we got the new TLA legislation from 1st of July, you cannot segregate assets in pension phase. Now, prior to that, till 30th of June, what you could do is, let's say if you had 2 million worth of pension assets and 1 million of accumulation assets, out of that 2 million you could have, let's say, a parcel of shares of, say for our example, 1 million, which would be segregated, and the remainder and segregated for pension members. So out of the 2 million which is in pension, 1 million is segregated and which belongs only to pension members, and the remainder 1 million could mix with the accumulation account, and that component is called the unsegregated, where it is mixed. Now, unsegregated means that some of the assets are current and some of the assets are non-current, and the ones which are segregated specifically for pension members, they were never included in the calculation of ECPI because all those assets belong to pension members, and the income coming from those assets would always be exempt because they are 100% pension assets and they are earmarked for pension members. So this segregation of assets is no longer possible going from 1st of July. So if you had that same $3 million of assets going forward from 1st of July, all assets would be mixed assets. And if the pension was more than $2 million or was $2 million on 1st of July, you would be able to move only 1.6 million into the pension phase, and $400,000 you had the choice to either withdraw from the superannuation fund itself, or what you could do is move from your pension account into an accumulation account. So you had $1 million worth of accumulating members, and from the 2 million pension members, you will move 400,000 into an accumulation account. Now, the section of the Act is the Income Tax Act 295-390, and it says the proportion of the ordinary income and statutory income of the complying fund that would otherwise be assessable income is exempt from income tax under this section. And the way the legislation talks about it, talks about average value of current pension liabilities. Since the balance keeps on changing during the year, and there are various reasons why the balance keeps on changing, and I'm going to talk about that. But primarily, an accumulation account would move because you will get more contributions into the fund, or you will roll over the money into another fund, or you could basically take a lump sum if you were over the preservation age. So what you get is a percentage, and that percentage is applied to income of the fund, and we're talking about ordinary income and statutory income and not contributions, and that percentage would be exempt. So if you had a fund of say 1.5 million, 1 million is in pension, 500,000 in his accumulation. That means that average figure which you will get is two-third. So two-third of ordinary income and statutory income will be exempt from tax. Now, unfortunately, the law doesn't define what is average, because average balances can be daily balances of the members, it could be monthly balances of members, and it could be quarterly balances of the members. Now, and it is subject to manipulation because if you apply the same set of figures with 10 different actuaries, you'll actually get 10 different percentages. And the reason you get that is because that is how they have programmed um, their calculations, their spreadsheets, and that is what percentage spits out. The program spits out that percentage based on how the Excel sheet has been programmed. Now, let's have a look at what a typical accumulation account will look like. Because we earn income during the year, like we receive rent every month. So if all members were in accumulation, the member balance is actually going up on a daily basis. Now, if you make a contribution, then you get a jump in the accumulation account, and then you start earning more income, and then slowly, steadily, it keeps on going up. So, and then if you make another contribution, then of course we get a second kick, and then we get a new balance. But this is what happens in reality, but this is not how we show it, because we have a set of accounts which we create on 1st of July, and then we create a a set of accounts on 30th of June. So the way it is shown in the financial statements is that we have an opening balance on 1st of July, and then a contribution comes in. So this balance remains more or less flat. And if we were to work out what is the balance because of this contribution, we'll have a new balance, and then we'll have another contribution. And then what we do is we value all the assets on 30th of June, and we credit if there is income, and then we increase the balance of the members if there is any unrealized capital gain, and of course all the income is also credited. So we then have a different balance on 1st of July of the following year, and we move on like that. Now, a typical pension account looks a little bit different, because although we have income, so we have an opening balance. Now, assuming this is a full 100% pension account, there's only one member in the fund. So we have an opening balance, and then we are receiving rental income, and then there's a pension withdrawal. So what basically happens to that account is that certain amount of money, and it could be taxable or tax free, and we're not talking about taxable or tax free, because they are withdrawn in the same percentage, whatever it was when you commence the pension. But then the balance drops, and then it starts increasing again, and then it drops again because you've made a second withdrawal. Now, you could have several withdrawals, and the legislation talks about that the minimum amount should be withdrawn, and that minimum amount can be once in a year. Um, what we have seen, and there are different types of pensioners. Some want a monthly balance, uh, some in their own personal bank account, and they withdraw on a monthly basis. Some pensioners withdraw once a year in the beginning of the year. Some pensioners withdraw at the end of the year. So it all depends on how they behave, but the balances actually are increasing on daily basis. But that's not how we show it in the financial accounts, because the way we show it in the financial accounts is that the income is actually, and the unrealized gain is actually credited on 30th of June. Now, this is a typical set of accounts. We have pensioner balances are flat, and the withdrawals are being made. As you can see, this withdrawal is a little bit less, and this withdrawal is a little bit more, so the balance drops, and then it comes back to what it was. So if we have withdrawn 4%, if the return is 4%, we are more or less back to where we were. And as far as the account is concerned, we've got three contributions coming in, and this could be two members on pension and two members in accumulation. So we're just representing, and we're just showing in a graphical way that the credit is actually made on 30th of June, and that's how we can measure it. Now, if I was to prepare a set of accounts on 1st of July, my balances would be different, and of course, I will be crediting or debiting uh, the the accumulation and the pension account on 1st of January, and I will be having a new balance on 1st of January, and then I can commence again. So having to do accounts on 1st of January means that I have to look at all the assets, I have to credit all the income to the two member accounts, and then I have to work out the capital gain or loss which is unrealized in all the assets, and then debit or credit the accumulation account and the member accounts. Now, what is an average, and how the average is usually worked out against comparing it with total superannuation liabilities, we look at the opening balance of the pension account and the accumulation account. We look at the date of contribution, because if the contributions are made very early and they are large contributions, so the amount is quite high, it is quite possible that accumulating members will have a higher or a bigger balance than pension members, because although the pension members started with a low value, but because of the contributions made by accumulating members, it is quite possible that the accumulating member may have a larger balance. And it also depends, the average is quite influenced by the date, because although the contribution was made and of a larger amount, but if it was made later in the year, there was more money uh, of pension members, so it is possible that the average could go either way. So we look at the date of withdrawals, when the pensions were withdrawn, and the amount of pensions, and the other factors like we have commuted the pension or certain specific expenses. As you know, life insurance is deductible, so we want the expense to come out of the accumulation account because it's tax deductible and not from the superannuation account. So this is just to show that income is earned daily by the fund. So if you were on interest, if all your assets were a bank account, so you will earn income more or less on a daily basis, but the credit to the account actually comes till the end of the year. Now, we know what is unsegregated and what is segregated. A segregated fund is basically all the assets of the fund are paying a pension. That's 100% segregated fund. What you see on the screen now, it's a 100% unsegregated fund where all the assets are mixed. So we have accumulating members defined by the yellow line, and the green line is for the pension members. So in an unsegregated fund, because the income is coming on a daily basis, we need to decide what percentage did these people have. So this being the value of the fund and this being the time of the fund. So how much money was there by each member on that certain date, and once that percentage is worked out, we get a percentage from an actuary. Now, when we have a fund which is 100% in pension, so we're looking at a fund now um, which has two members, member one and member two, say husband and wife, and they had certain opening balances. And you can see that the two members have behaved very differently. One member withdrew a large amount, whereas the other member withdrew a smaller amount. And then in the second withdrawal, the second member withdrew a larger amount, and the first member withdrew a smaller amount. And there were several withdrawals, whereas member number two, which member number two made, and member number one never made any more withdrawals. And this fund is a segregated fund, and all the assets are basically in pension phase. Now, this is a typical fund prior to 30th of June 2017, and we know that a fund cannot be 100% in pension phase if the balance is more than 1.6 million. So we'll add another complexity to our situation, but we'll just have a look at what the fund will look like if it was 30th of June 2017. So we had member one who had 1.258, and then there were certain withdrawals, and then the closing balance of the member on 30th of June 2017. Uh, the member balance is below 1.6 million on 1st of July. So for the years 17 and 18, this fund will remain a segregated pension fund and will not need an actuarial certificate, because none of the members' balances have actually breached the balance transfer cap. Now, some of you may not know what is a balance transfer cap, so this is a little bit of uh, a run up on this one. So, what the government is trying to establish is that if you have 1.6 million in the fund, that bit can only go into retirement phase. So it limits the amount of earnings which can be exempt from tax. I mean, what we have seen is Peter Costello coming um, on the 1st of July 2007, some 10 years old back, and said that it doesn't matter how much you have in the fund, all the income will be exempt. And now we have a treasurer 10 years later saying that only 1.6 million can move into retirement phase. And if you had more money, and I remember in 2007, I was talking to a lot of trustees, they wanted to actually sell their investment properties. And because they were paying tax outside of super, they wanted to sell those properties and move those because they were residential properties. They could not be purchased by the self-managed super fund. So they had to actually sell those properties and move the cash into the super fund, and you were allowed 1 million per member to contribute into the fund. But we have this new limitation of 1.6 million, which and the balance transfer cap works as a debit and credit system, because if you start a pension with 1.6 million, if you withdrew more than the minimum amount, so instead of taking a pension, you could actually take a lump sum out of your pension account, which will then create a debit. And then if you contributed more money into the fund, then because you're reducing it from 1.6 million, say you took a large amount, and you've met the minimum amount, you could actually reduce your balance transfer cap uh, in hope that you will make some contributions. Now, this new rule came into legislation on the 29th of November. So all those funds which were already in phase on that date, they will have to comply with this new rule. Now, from 1st of July, if you were in accumulation, so let's say years going forward, 2-3 years from now, um, if you had say 3 million and you were in accumulation, then you can only move 1.6 into a pension phase. So you'll have two options. So out of 3 million, because 1.6 can go into pension phase, you can withdraw the excess amount out of the superannuation fund. Or what you do is you commence a pension with only 1.6 million and you leave the remainder 1.4 into an accumulation account in the same fund. Now, there's another thing which has which has changed, is that transition to retirement pension will no longer be tax free. So, uh, transition to retirement pensions are where a member has met uh, the the required preservation age. However, the person is working more than 10 hours a week, and he's not fully retired. So, and there's separate rules if you are less than 60 years old. What does retirement mean? I mean, you can give up work and start again, but once you're 60, there's a different set of rules. A fund which was paying a transition to retirement up to 30th of June, going forward from 1st of July, all those assets supporting a transition to retirement pension will be subject to normal tax. Now, let's just understand there's another complexity, which is the CGT relief. And I can see I can, um, it's quite overwhelming to look at what you see on the screen now. CGT relief is only available to certain members. And if you were under preservation age, then the CGT relief does not apply to you. And if you were over the preservation age, you had to make sure that you were on pension on 9th of November. And it is only applicable to those people whose member balances were more than 1.6 million. And then there were two methods. And we're going to discuss one of the methods where your pension balance was more than 1.6 million and the assets were segregated. So when the assets are segregated, and if you sell an asset, and we call it a deemed sale. So when you sell an asset, what basically is happening here is we had 1.858 in the beginning of the year, and we withdrew certain amounts at certain levels. Member one has an issue because on 30th of June, the member balance has actually reached higher than the balance transfer cap of 1.6 million. So we have a component, we have some figure. So on going on 1st of July, this member one will have an issue because $175,000 is above the balance transfer cap amount. Now, there are various reasons why the member balance has gone up. One of the reasons why the member balance has gone up above the 1.6 million is because of the pension withdrawals. Now, if you're preparing accounts, as you can see, there is another member two, which had 1.257, and there were larger withdrawals from this account. So if you were to switch over from this withdrawal from member 2 to member 1, then it's quite possible the end result would be different, because then this member 1 will not breach the 1.6 million balance transfer cap amount. But then another thing which we need to note is that the balance has actually gone up over the 1.6 million because how we have allocated the income to member 1 and to member 2, and how we have actually credited that income, because a part of that income is unrealized gain. So we have to look at how we have valued the assets on 30th of June 2017. So allocation of income, we have to look at the legislation, and once we value all the assets to market value, we are guided by SIS regulation 5.03, and it talks about that the trustee must credit or debit the members' benefits in a way that is fair and reasonable. Now, just going back to this situation. Now, if this is a husband and wife situation, I'm not sure what is fair and reasonable, because I think it will be fair and reasonable if I allocated more income to member two, because member two has only 9,926,000. So if I allocated, say, 175,000 extra to member two, I'm not sure whether the auditor will have a problem with that, because I'll be just taking relief from SIS regulation 5.03, because it talks about that the allocation of income must be to all members and the various kinds of benefits for each member of the fund. So since both the members are in pension phase, so it's basically pension, and they're related to each other, and if they don't have an objection, then it is possible that we allocate more income to one member than to the other member. Now, uh, me being an auditor, I look at the member balances and I look at the income which has been credited by the accountant, and I will question it, on how it has been calculated. Most of the accountants don't even know how the accounting software credits that income. It's a matter of just clicking the button, create entries, and the software does whatever it does. Usually, the software will look at the daily balance of the member and then allocate income to each member. Now, as far as fair and reasonable is concerned, um, if um, if I was to ask the other member that is it fair that I take some of the income? Would you have any problems with that? And I minute that. And I talked to my auditor. Would he have an objection if I did that? Then I guess you should be thinking about how you would allocate those assets. Now, the second thing is the valuation of assets. Now, we are again guided by Regulation 8.02 of CIS regulations, and they talk about that asset must be valued at market value, and market value is defined by Section 10(1) of the Act and says in relation to the asset means the amount that a willing buyer of the asset could reasonably be expected to acquire the asset from a willing seller. That's fine. We do understand that. And the accounting standards, if you look at the accounting standards, AASP 1056, and you look at the accounting standards on fair value measurement concept, and they talk about that the valuation could be done in several ways, and they talk about certain costs which could be incurred in the sale. And then, like if you had a property, let's say if you had a property, going back to our fund, the assets are about, say, 2.7 million or thereabouts. If there was a sale to be made, and if the asset was a property, and if there was 2% commission being paid on, say 3 million, so it's quite possible that we had 60,000 not coming to the members, because that would be paid out on sale to a real estate agent to sell that property. So we don't have a problem of 175,000 anymore, because the valuation has not been done properly. Now, there could be some accumulating members, and when you do sell an asset, there could be a capital gain, and that means that you have to do tax effect accounting, a deferred tax. A deferred tax is a liability, and then what you do is, instead of crediting the member, you actually credit a deferred tax liability which the fund may have to pay in future. So valuation of assets could be one area where you could look at for your funds, which are really borderline cases where the member balances is just going up by a few thousands of dollars over the 1.6 million. Now, let's just look at the transition CGT relief and what the rules are for the segregated asset. Basically, the rule is that from 9th of November to 30th of June, trustee could have two options. Either option one was to remove the assets from the segregated pool to an unsegregated pool, or move that particular asset into an accumulation pool. So if you move it to the accumulation pool, then that fund will have an accumulation account, and if it has an accumulation account, then it would pay tax on income. Now, it's very important when the trustees decide to move the asset to an unsegregated pool or to an accumulation account, because the result of both of these actions is that the fund becomes taxable. Now, why would you move an asset out of the segregated fund on any day other than 30th of June? And the reason why you will do that is it's quite possible, like if you had BHP shares, you have to look at the value of BHP shares from 9th of November to 30th of June. And because it is a deemed sale, so that you don't have to pay tax later on, it's quite possible that BHP was highest maybe in March. say March the 13th, and you would like it to be a deemed sale on March 13 and not 30th of June. And if you did that, then because it's a deemed sale, then that is the value which would be your purchase price, the 13th of March. So when the asset is actually sold later on, you would look at the cost base, and your cost base is the highest value between 9th November to 30th of June. And if it is 13th of March, that date or that cost becomes your new cost base when you work out your capital gain from 13th of March to the actual sale date when you actually sell your BHP shares. And because you're moving the assets from a segregated pension fund on the 13th of March, the asset is coming out from a 100% pension fund, and that is why you ignore any capital gain. Because prior to 13th of March, the fund was 100% segregated pension fund, so no capital gain tax has to be accounted for. Now, just to have a look at a situation where this is a segregated pension fund where all the members are in pension phase, and there is a single asset, and that's a single asset is more than 1.6 million, and it doesn't matter when we are moving the asset from 9th of November to 30th of June, but the concept which we need to understand is that we are either moving it to accumulation pool where the asset will be taxable, or if you're moving it to an unsegregated pool, then again income tax would be paid on proportionate basis. Now, when these assets actually move, we have to maintain our records, and the cost base has to be recognized because we are actually selling it and buying it back on the same day. Now, let's go back to a fund, and we'll just, instead of complicating it, we'll just look at a situation where there is only one member in the fund. So let's go back to our own, the first, the fund which we were looking at. All I've done is I've removed the second member, and we have member one who had balance of 1858 on 1st of July 2016, and there were certain withdrawals, and some income was credited to the fund, and because of that crediting of income to that member account, we have breached the balance transfer cap, and we have a balance of 1.775. So the two options are to withdraw the 175,000 going forward on 1st of July, or what you do is you move 175,000 into an accumulation account for that same member. So on 30th of June, you will have, or the actually saying 30th of June is actually incorrect. On the midnight of the 29th of June, you will have an accumulation account for the member if the idea is not to withdraw money out of the self-managed super fund. So what we are basically doing is we are commuting a part of the pension. So we were running a pension till 29th of June, and then we commute it on the midnight or the morning of the 30th, and then our commutation commences an accumulation account, and 1.6 million remains in the pension account. So just let's have a look at what is really happening. During that period, now we have to look at this period. The period is one day practically. So this 1st of July is actually very close to here. So it's the midnight of 30th of June and the morning of 1st of July. So there is there's no gap here. So the income may be earned during this period. Now we know during this period, the fund that is before 29th or the midnight or before 30th, all the income is in a segregated pension fund and it is exempt. all of a sudden we have an unsegregated fund on 30th of June, and we could be liable for uh, some tax based on some proportion, depending on what is my pension balance and what is my accumulation balance. Now, it's quite possible we looked at the fund where only 175,000 is moving into accumulation. Now, imagine if this fund was $18 million fund. If on that date, on 30th, we had 18 million in the pension account, on the morning of the 30th, we can move only 1.6 million. So, we're looking at about what to about 15.4 million can be in accumulation phase on that day. So there could be a substantial amount of money which could actually move to accumulation. So what happens to income if we earn income on that day? So the question is, on 30th of June, we have an accumulation account, and now we have to work out whether we earned any income. Was there anything received by the fund on that day? And does the fund want to claim any deduction? So if we did receive, let's say we received $50 income, the cost of ECPI, the application, could be higher. So maybe we just decide to pay tax on that $50 full, and if we are going to pay 15% tax on $50, it's going to be only $7.50. Now, just to expand this period, so we have this period. So what I've done here is I've just expanded it a little bit. And what we have seen here is that we have certain period from 1st of July 16 to the midnight of the 29th. So all that income, so let's say the fund has one property and it receives income on last day of every month, and the income it receives is $10,000 per month. So during this period, because it's a segregated fund, then all the income is tax free. But on that one day, we received $30,000 rental income. We had only $175,000 in accumulation, and we had $1.6 million. And going forward from 1st of July, that accumulation account continues, and the pension account also accumulates, and then it does its wriggly bit, withdrawals and things like that. So we need to work out for this particular day on how we are going to work out our calculations and what is the ATO's view, and what does the industry has been doing till date. So no, just going forward, so we have a timeline which is here. We had 1.858, and we have moved from 1st of July. It's a period till 29th midnight, or 1st of July, or 30th of June. So whichever date you think is appropriate for you. So for that one date when we earned rental income of $10,000. So what the industry practice has been, they look at the whole year, they look at the whole period. So they look at the opening balance of the pension account. So what was the opening balance of the pension account? So it was 1858. And what was the average pension account, that is the pension withdrawals, the dates? So what was the date when the amount was withdrawn, and how much was it withdrawn? And the pension account reduced on a certain date. So you can literally say that this fund has one member, but there are three accounts. One account is this pension account, and this pension account was 100% commuted. So we finished this pension account, and then we started two accounts. So account number two is the pension account, and account number three is this accumulation account. So when did we set up the accumulation account? The date is very important, which for us would be 30th. So for one day, we had an accumulation account. And what was the average balance? Did we withdraw any money from that accumulation account, or or did we withdraw any pension from the pension account on 30th of June? So that's going to be important. So what we do is we work out. So we enter all the details. We provide these details to the actuary. And you can see that because a lot of money has been in pension and $175,000 has been in accumulation, the exempt percentage will be quite high. And it's quite possible that almost 99% of this income, or rather, you would say this is 1 by 10 for that particular day, but we count these number of days, it's quite possible that 99% of the income would be exempt. Now, this is how the industry understands, this is how they have been calculating till now. Now, what the tax office has said that I'm fine with that till 30th of June, but going forward from 1st of July onwards, I will not accept this method anymore. And I'm going to discuss what is their method. Now, the ATO's view is this, that just going back so that you're able to compare. So what I've done is from 1st of July till 29th of June. So the ATO's view is that from 1st of July to the midnight of 30th of June, uh, the fund is 100% in segregation phase, segregated pension fund. And the balance could be more than 1.6 million, so it doesn't matter much what the balance was, because you could have any amount till 30th of June in your pension account. And because we are receiving our rental income on the last day of the month, the whole of $110,000 is exempt. The reason it is exempt, because the fund is in 100% pension phase. Now, when we commute the pension on that day and when we received 10,000 rental income on that one particular day, we need to work out that what is the amount which is in accumulation phase and what is the amount in the pension phase. And you will see that almost 11 or 12% or 15%, whatever that figure is, was in accumulation. So it's quite possible that when we do our actuarial calculation, it's probably 85 or 87% will appear to be in exempt percentage, and that means that about 80, say 8,700 could be exempt, and $1,300 could be paying tax. Now, um, that's not the way the industry looks at it, and they look at it that it's going to cause lots of problems going forward. And let's look at what those problems could be. So now we're just thinking that instead of moving the asset, the BHP asset, on 30th of June, we are moving the asset on the midnight on the 9th of November, because let's say that is the date where it was the highest. So we have moved the asset out of the segregation a bit earlier. So we have a period of only 4 months, because we are receiving rental on the last day of the month. So July, August, September, and October. So only four or $40,000 is exempt, and any calculation of ECPI calculation would be from this period to this period. So the period where we haven't had an accumulation account has gone larger, and also the rental income has been separated from when it was in 100% segregation mode, and when it is in unsegregated mode, that is from 9th of November 2016. So you have to be very careful on on deciding which day the asset must come out of at the segregated pool, because you have to look at the highest value of that asset during the period from 9th of November to 30th of September, and then decide which method will give you a better result, because it's quite possible the asset was quite high, so you would want that price to be the deemed purchase price. You want that price to be the new cost base of that asset for any future sale. Now, this up till now we have looked at what is going to happen till 30th of June. Now, moving forward, now we are going to concentrate into the new period from 1st of July, because we cannot use the tax office concept anymore. So what I have done is from 30th of June, or from 1st of July to 30th of June 2018, I'm not going to look at this period anymore. I'm just going to look at the period starting from 1st of July to 30th of June. So let's say what this trustee does. He says, I don't want an accumulation account. I'm going to withdraw this money. So there is no more um, there's no more accumulation account. So we have a period, and this could be any date. So we have a period, and the period is from this line to this line. It could be any date, and there could be not only any date, there could be several dates, and we don't know this period as well, or whatever that period is, and there could be some pension payments here as well. So we will need an actuarial certificate from this period to this period, because we have accumulation account and a pension account. But this period, there is no accumulation account. So whatever the income is, it is 100% exempt from tax. But then we get a new contribution. And if we get a new contribution, then again we have a problem, because what we need to do is we have to look at the value of the pension assets as on that date. So we have to prepare a set of accounts again to find out what is the opening balance of the pension account. And once we know the opening balance of the pension account, we can then work out what or how many withdrawals were made since that date. So this could be a total nightmare, because there could be lots of contributions being made. Now, one of the solution is that as soon as this contribution comes in, you convert it into pension on the same day. And if you're able to do that, we'll never have an accumulation account. So, life could be very, very simple. So this period could be extended, and we could have 100% exemption, because we no longer have an accumulation account. Now, there is another way. Let's say if the withdrawal is made, what we do is that instead of withdrawing the whole amount, because what we don't want to do is we don't want to calculate the value of the pension assets. So what we do is we leave $1 in the accumulation account, and then we withdraw 174,999. So the exempt percentage will be quite high, because for most of the period we had only $1 in accumulation, and we don't have to value the pension account anymore, because we always had a fund which was unsegregated for the whole year, because from 1st of July we had a large amount, and which was paid out as lump sum. The retiree took the money out, but we don't have to redo our set of accounts, because we always maintained an accumulation account. So the fund was always unsegregated for the whole of the year. So this could be one of your problems. Now, just almost on my last slide, and I can see that um, some of you have a few questions for me. And before I get to the questions, let's have a look at a different problem which we may have. Um, Let's say if the fund is in 100% segregated fund and we did not breach the balance transfer cap, and on the income on 30th of June, is greater, and we're going to talk about that very soon. Sorry, I've got this figure wrong, so this should be 1775. So let's say the situation is, I must apologize, this figure should be 1775. So I'm just going to come back to that. So let me explain you the situation. So we had for that year a certain figure. Then on 1st of July, instead of we maintaining an accumulation account in the fund, what we did is we withdrew the amount in excess of 1.6 million. So on 30th of June 2017 or on 1st of July, we had 1.6 million. Now, uh, we did not have an accumulation account. Uh, the fund stayed 100% in pension mode, and it is a segregated pension fund. And what has happened is the member withdrew some money, and then there's a second withdrawal pension account. A pension was withdrawn, and then what has happened is the 1.6 million on 30th of June has been breached. So now, sorry, this is 1.775. So on 30th of June 2018, the balance is more than 1.6 million. So the way the current legislation is, it says that you will need an actuarial certificate because the balance has gone more than 1.6 million. It has reached 1.775. So the balance is 175. But because the reason why that has happened is because the income is more than the withdrawals. But because the balance has gone more than 1.6 million, you will need an actuarial certificate, and the result of the actuarial certificate will be 100% pension. So what we are doing, what the industry is doing is the Actuarial Institute has also requested the government to actually nullify the requirement, because the test whether the fund has not breached the balance transfer cap. The test is on 1st of July. The test is not later on. Now this could have a different result as well. If the income is lower than 1.6 million, or the income is lower than the pension amount, then your balance would be definitely below 1.6 million. So you'll not need an actuarial certificate. So what they are saying is that any growth in the pension account should not require an actuarial certificate. Um, so we've gone through various things, and what you need to be very wary about on what you're going to do, especially where your client on 30th of June has a balance of more than 1.6 million, and what the industry practice has been, and what the ATO's view has been. So we need to first of all look at whether the fund has earned anything or not. I more or less come to the end of the presentation. If those people who have understood the concept can leave the presentation, leave the webinar, and those who have raised questions or those who want to know what other people have asked, they can stay on the webinar. Okay, as I mentioned earlier, um, uh, a copy of the presentation can be made available. You need to send an email to Raman, Raman, at trustdeed.com.au. Now, just one thing I want to talk about here. We've created a new website, and you will be able to apply for actuarial certificate from $55. And next week, those accountants who are using online SMSF audit will be also able to apply for actuarial certificates for $55. So if you're an auditor, please let your accountants know that applying through the accounting software could cause problems. They can use online smsfaudit.com.au, or they can go to ecpi.com.au and they can apply for actuarial certificates. Now, if you cannot download this presentation from your panel, please send an email to Raman, Raman, at trustdeed.com.au. I can see that I don't have many questions. There is a question by Tanya. In the case of market valuation, are you saying that market revaluation should be deducted by deferred tax liability before allocated to the member's account? We didn't have that approach and the auditor didn't object. What I'm saying about valuation is that you can prepare a set of accounts according to deferred tax method. And if you did that, and that is only possible if you have accumulating members, because if you have accumulating members, some of the assets will pay tax. It's quite possible that your unrealized gain will be a bit lower. But certainly, you can do one thing: you can factor in the cost of disposal. You will need a solicitor, you will need a selling agent. And then, what is market value is a question by itself. And in fact, I don't audit many funds, but if I see a fund which has got a property in there, I'll be probably asking, to asking the accountant to engage another auditor, because I'm going to qualify the audit report. So any fund which has property, it'll be impossible for you as an auditor to approve that valuation. So I will be lodging a contravention report, at least letting the tax office know that I don't know whether that valuation is correct, and I cannot rely on the accountant's valuation because I have no idea of what the market value of that asset would be. Okay, Tim has got a question. What section of the tax return would you input segregated asset that becomes unsegregated assets on 30th of June, and you reset the cost base? There is. I'm just going to open another presentation, and I have that information in that presentation. If you just allow me just a couple of seconds, and that presentation is going to be, by the way, next week. Those who have not registered themselves can register themselves. So on my screen, you will see that you have to look at question number 8. You have to look at, if you're applying for that CGT relief, you have to look at the schedule and say the CGT schedule. And there is a question there: have you chosen to apply the transitional CGT relief for superannuation fund? You're supposed to say yes. And notional capital gain is only to be calculated if the funds were unsegregated on 9th of November. So those funds which were segregated, there is no capital gain. Capital gain is absolutely ignored for those funds. So your question, Tim, whether there's if the fund was segregated on 9th of November, there is no need to show it on your tax return because the capital gain is ignored. But you have to still say yes in this column, and you have to, of course, keep a set of records for your auditor and for the trustees. Okay, Roger has a question, and I believe this is the last question I'm answering. For a two-member fund where each member balance is 700,000, one in account based and the one in TRIS, both member accounts are segregated. SGC contributions are received each year, all also segregated. Does this fund need an actuarial certificate? Now, the way I look at it is that TRIS is going to pay tax, an accumulation account is going to pay tax. Because you can't claim any exempt current pension income, because TRIS is no longer tax free. So you are basically in accumulation phase. And because you're in accumulation phase, you're not in retirement phase, you cannot claim exempt current pension income. So you will not need an actuarial certificate. Thank you, guys. Thank you for being with me. Now, if you go back to the webinar page where you booked for this week, there is another there's another webinar next week on Thursday at 2 p.m. And now I'm going to add a webinar once a week. So uh, just keep on looking at that page. I'm sure you'll find something interesting. Thank you very much. And everyone have a good week.